Thursday, July 23rd, 2020, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at financial repression and how it's going to affect investors. I'm going to look into a very good opinion piece in the FT, believe it or not, before we go into it. And I think it's a really good, important opinion piece. We'll look at where the markets are this morning. It's almost 8:30 a.m. London. Precious metals, of course, continued their move yesterday. Quite amazing moves. Silver has been up above $23, of course. It's come off a little bit overnight, but still relatively strong. Gold has continued to move higher. We're at 1874, up about $3. The high has been 1877 and the low has been 1863. So we're way past that 1825 level. We still could go back down to retest 1800, 1825. And in my opinion, in the long term, that wouldn't change anything. Same thing for silver. 2115, of course, was a key resistance before this week, and we broke through that level. There's also a level at 2140 many years ago that's also important. So right now, silver is at 2275. It's down about 23 cents. I was watching it early last night. Well, not early last night here, but early in the session, just after 11 o'clock London, and silver got up to 23.31, but then it came off. The low was 23.36. So a $1 range is normal in these market conditions. There could be days where you could even get $2 ranges, I would say, or even more, the higher silver goes. The Dow future is up 61, up 0.25% at 27,059. S&P 500 is up 7.5. NASDAQ 100 future 10,910, up 0.33%. I saw Tesla had good results. They made a profit under general accounting principles terms. So there you go. The shorts are still getting slaughtered in terms of Tesla. I think you should watch the Market Sniper. A few days ago, he spoke about Tesla in one of his live streams. And he spoke about what he thinks Tesla is. So currencies, sterling down 0.1% at 127.21. The euro was pretty firm yesterday, remains quite firm. It's at 115.77, up slightly. Dollar index didn't drop as much yesterday because the dollar actually rose a little bit against the yen. Right now it's at 107.11 unchanged. The dollar's down versus the yuan here, just above 7, down 0.22%. Oil, WTI that is, 42.02, up 1/3%. Bond market yields remain subdued. The 10-year yield is at 0.59. The 2-year yield is at 0.15. So we're seeing the longer end of the curve come down here. So with that, let's go into the editorial in the FT about financial repression. I would say that I personally think this financial repression, and you will see what this means when I go through the opinion piece. I think it's already been happening the last few years, especially in the EU. Some of the rules, they've already imposed them on pension funds. So here we go. A new age of financial repression may soon be upon us. The battle to inflate away debt will be long and probably punishing for stocks and savers. That's what I've been talking a lot these last few months, especially with all the programs from governments and central banks to inflate the system, to keep the system going, all the stimulus. But I also spoke about this even before the current crisis, the last 4 years. that they would have to inflate the debt away. And that was one of the reasons why I thought they wouldn't be able to stop all the QE and that it would be difficult for governments to stop borrowing and spending. So let's go. The guy's name is Russell Napier. He works for a firm called ERIC, ERIC, High Quality Global Investment Research Discovery, Evaluation, and Procurement Marketplace. Purpose. Together we are creating a better informed, more transparent, liquid, and truly functioning market for unbundled substantive investment research products and services globally. I think they're based in the UK. So let's go through Mr. Napier's opinion piece. During the COVID-19 crisis, control of the supply of money has quietly passed from central banks to governments. As a result, investors need to prepare for a new era of inflation. I've been saying that as well. The sudden move to supply government guarantees on bank lending has created a surge in loans, and with it, as commercial banks' balance sheets expand, a rise in the growth of broad money. If you listen to my interview that I published a couple of days ago with Alan Myers about how currency or money, if you want to bracket the money here because we know what real money is, gold and silver, is created in this system, it is through the commercial banks. So Mr. Napier knows that. In the UK, for example, £23 billion of government guaranteed bounce back loans had been created by the end of May, showing that the fractional reserve banking system had been pressed into service. So basically what he's saying here is that the governments are pushing the banks now to do the fractional reserve lending, not the central banks. This discovery of the magic money tree allows governments to push funds to smaller businesses and households. This ultimately will be seen as the route to fund all sorts of politically necessary ventures, including green initiatives, because guarantees cost governments nothing beyond a contingent liability should the assets turn bad. An age-old solution to such problem credit would be then to lend more money to keep debtors current to both interest and principal. The shaking of the money tree has only just begun. So far in this crisis, market participants have focused on the flurry of actions from central banks, but have mostly failed to notice the central bankers' increasing impotence. The silent revolution in the creation of money means that there are very limited prospects of inflation expectations remaining anchored. The surge in equity prices since a trough in March might suggest that investors have begun to price in that reality. However, the inflation rates derived from index-linked bond markets show that expectations of price rises remain at remarkably low levels across the developed world. And here's the interesting part for us who look to precious metals as a protection. Gold will remain the best way to retain the purchasing power of savings, but there is also an upside for investors from inflation-linked bonds. The outlook for longer-term returns for equities, however, is more difficult. While previous rounds of reflation have almost always been positive for stock prices, at least at the start, this reflation is likely in due course to force an aggressive form of financial repression. Efforts to inflate away debts require that market-determined rates of interest are abolished. Yield curve control, or capping borrowing costs, is a necessity and will be achieved through forcing savings institutions such as life insurers and mutual funds to buy government debt at yields below the rate of inflation. So there you go. That's how they do it in the real world. The bond buying has to be carried out through savings institutions and not central banks, which cannot respond to higher inflation by expanding their balance sheets to whatever size necessary to cap bond yields. Savers through government mandated bond holdings will have to bear the burden of capped yields and will watch a portion of their savings eaten away through inflation. This transfer of wealth from savers to debtors is politically difficult in all countries, but much more so within the Eurozone. Eurozone are the countries in Europe that use the euro, because there are some countries in the European Union like Denmark and Sweden who have their own currencies, where 19 governments are likely to disagree on the scale and pace of the process. The euro could be a casualty along the way, as the ability of member states to create money through controlling their commercial bank balance sheets is not compatible with a single currency. While many investors see equities as the key beneficiaries of enforced negative real yields. Well, what's negative real yields? That's when the central banks manipulate and the regulators keep nominal yields below the rate of inflation, so you get negative real yields. The mandated purchasing of bonds will eventually force savings institutions to dump other assets, including equities. This liquidation, moreover, is likely to come at a time of high equity issuance, as big companies find it increasingly difficult to access non-bank credit because governments will seek to limit the growth of total debt as they try to make economies less leveraged. None of that is positive for returns from equities. So here he goes into a period where there was financial repression when most of us were not even alive, or if we were very young. During the last peacetime financial repression from 1945 to 1979, equities performed well until the mid-1960s. This was partly because they were so cheap when the war ended, but also because they benefited in the transition from a wartime command economy to a more highly leveraged, consumer-driven economy. No such transformation is possible today in consumer-led societies, where private sector debt has already reached record highs compared to GDP. Moreover, equity valuations are much higher and savings institutions have large weightings of stocks in their portfolios to cut when compelled to do so. What that means is that the performance of stocks may have more in common with a period between 1966 and 1982 rather than the 20 years after the war. Even if nominal interest rates are prevented from reaching the lofty heights that we saw back then. From 1966 to 1982, large cap US stocks produced zero returns in real terms, and other equity markets fared much worse. In this new age of repression, the secret to preserving the purchasing power of savings lies not in the mix of assets that are held, but in the quantities they are held. And this is Mr. Napier's conclusion. Investors should hold as much gold and as little government debt as they feel comfortable with. So this is going to really hurt people who are, for example, working for the public sector or working for a big company that follows government rules on savings and investing for pensions. So yeah, I think the other thing people need to try to do is to try to avoid or opting out of those if possible and trying to take the money out and investing it yourself. That's not advice, but that's just what I would think of doing. So there you go. That's what financial repression is about. And it looks like that's what Mr. Napier thinks we're going to get. I think there's a good chance that that's what we will get. So what would be the only spanner in the works for this kind of financial repression from governments, from central banks in the Western world? Well, it would be some kind of social and political unrest that would change the way things are done right now, or the way things could be done, as Mr. Napier says. So I found this interesting that the FT gave this guy a platform to actually come out and talk about what could really happen here, because the debt is becoming unsustainable, and they have to try to inflate it away. As I've said many times, and even before the crisis. So there you go. If you enjoyed this video, please hit the like button, share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a very good day. Take care. Bye.